How rule-based investing silences emotions. Financial markets constantly trigger emotion. Fear during declines. Greed during rallies. Regret after missed opportunities. Anxiety during uncertainty. Rule-based investing does not eliminate emotion, but it reduces its influence on decisions. Here's how. 1. Rules pre-commit decisions. A rule-based system defines in advance. Asset allocation. Entry criteria. Rebalancing thresholds. Risk limits. Exit conditions. This is a form of pre-commitment, a concept strongly supported by behavioral research from Daniel Kahneman and Amos Tversky. When decisions are made before emotional pressure appears, the emotional brain has less room to interfere. You decide once, calmly, instead of repeatedly under stress. 2. Rules reduce decision frequency. Every decision activates emotional processing. Frequent discretionary decisions increase. Decision fatigue. Impulsivity. Inconsistent behavior. Rule-based investing minimizes the number of moments requiring judgment. Fewer decision points, fewer emotional spikes. 3. Rules shift focus from outcome to process. Emotions intensify when investors fixate on short-term results. I'm down 5%. I missed that rally. This is moving too fast. A rule-based approach reframes the question. Did I follow my system? This process-oriented mindset weakens. Regret. Overconfidence. Panic. The evaluation shifts from performance to discipline. 4. Loss aversion loses power. Loss aversion, a key concept introduced by Daniel Kahneman, explains why losses feel roughly twice as painful as gains feel rewarding. Without rules, investors delay selling losers. Investors sell winners too quickly. With predefined rules, loss limits are executed mechanically. Rebalancing is systematic. Position sizes are controlled. Emotion is replaced with structure. 5. Rules create psychological distance. When a decision is rule-driven, the system says reduce exposure. Instead of, I feel like selling. That small language shift creates emotional distance. Distance reduces ego involvement. And ego is often the amplifier of emotional trading. 6. Automation reduces impulse windows. The shorter the gap between signal and execution, the less time emotion has to negotiate. Systematic strategies, whether simple rebalancing rules or quantitative models, reduce hesitation, second-guessing, narrative construction. Emotion thrives in ambiguity. Rules reduce ambiguity. 7. Rules protect during extremes. Market extremes are where emotion peaks. Euphoria at tops. Panic at bottoms. A predefined allocation strategy, similar to the disciplined long-term philosophy advocated by John C. Bogle at the Vanguard Group, enforces staying invested during fear, rebalancing into weakness, avoiding speculative surges. Rules provide stability when emotion becomes unstable. Important clarification. Rule-based investing does not mean blindly ignoring new information, refusing to adapt when conditions structurally change, eliminating all judgment. It means that judgment is structured, not reactive. The psychological mechanism. Emotion is strongest when outcomes are uncertain. Identity is involved. Money is at risk. Decisions feel personal. Rules reduce personalization. They transform, I hope this works, into, I follow the system. That shift is powerful. Final insight. Markets will always trigger emotion. Volatility will always test conviction. Rule-based investing doesn't remove fear or greed. It reduces their authority. And in long-term investing, the goal is not to silence emotions completely, but to prevent them from making decisions.